Fundamental analysis, day 5. Key things, let's go through them. First up, you need a bit of a macroeconomics understanding. I'm not going to dwell too much on this, but essentially the main areas of macroeconomics that you need to understand are GDP, employment or unemployment, and inflation. Now, GDP is total goods, employment is self-explanatory, inflation is the rise of prices. Now, this is good if you're borrowing money, so good for borrower and bad for saver. Why is this? If you are a saver and you have $1,000 in the bank or £1,000 in the bank, if inflation is going up, this £1,000 this year or next year will not buy you as much as it does at the moment. So what's happening is, even if you are earning, say, 5% interest, you're earning $50 a year. If inflation is rising at 8, you're effectively losing 30, the difference between the two. So that's your real inflation. You're actually losing that, because in a year's time, what the inflation rate at 8% means is that £1,000 is going to buy you 8% less next year. Whereas for a borrower, this is good, because your loan amount is going to stay the same. So over time, what you're earning theoretically should rise with inflation as well, and therefore the amount that you pay back is actually less compared to what you're currently earning. So that's your general idea of economics. Inflation is generally seen as a reasonably good thing if it's rising around about 2%. Employment, you're looking at the 3 different types. So you've got structural, frictional, and cyclical. And these basically come down to structural is if your industry actually changes. So, for example, mines closing, the industry has changed, that's where the unemployment comes from. Frictional is when you're in between jobs. It's rare that you just leave one job and start another one immediately. And then cyclical unemployment is to do with the business cycle. So ultimately, macroeconomics is based around supply and demand, supply for the goods in your country, supply of goods, demand for those goods that you create, also the supply and demand of labour as well. As a general rule, GDP going up, employment will rise with it. Quite obvious when you think about it. If more goods are being produced, you need more people to produce them, therefore demand for employment rises, people get more jobs. What this does potentially have the effect of doing, though, is increasing inflation, because as more people earn more money, they then spend more money on those goods. If the goods can't be produced as fast as the demand for them, then the prices start to rise. And that's how you end up with a business cycle. You end up with these sort of peaks and troughs. Ultimately, generally, you are moving higher. That's your productivity. If the country is continuing to produce things, yes, the economy can get a bit overheated as inflation starts to rise, as you get this pick-up, this build-up. But as the inflation rises, it then pushes costs up for companies. You then start seeing employment fall because they're cutting costs, and that's how you see the economy dipping back down. So you do see this kind of business cycle, this flow, as time goes by. And that is very key for trading, and that is the whole point of this. Understanding the macroeconomics is for where you're actually going to get a trade. Now, in terms of economic data, not trading's trading, in terms of economic data, where you are in the business cycle is very important. Also, where you are for monetary policy is key as well. So remember that business cycle and monetary policy are the two key areas as to why certain figures will be more important. US figures are the most important because the US is the largest economy. It affects more and more people, and most markets do some degree of trade with the US. So US figures are very important. The key ones: non-farm payrolls, retail sales, and then your inflation, CPI, and GDP numbers. There's quite a lot of other numbers, but they are all essentially adding into those numbers, as you already know. In general as well, keep these things in mind, or know what the result of a figure is going to do for certain markets. So is it good for stocks? Is it good for bonds, currency, or commodities? And varying figures will make a bigger difference. So, for example, stocks don't follow the inflation rate that much. They will in times when it is going to directly affect monetary policy, because if inflation's rising, monetary policy is likely to become tighter, so interest rates will rise. So stocks may well then start to have an effect or start to fall. Inflation is going to affect bonds and currencies to a much greater degree. Whereas employment, that's going to be very important for stocks, because more people in jobs is generally good for companies wishing to expand. So be very aware of what is important. As a general rule, things that are good for the economy are good for stocks. Things that are good for the economy are generally bad for bonds. This is a risk play, basically, that as things improve, you will take more risk, so you will own stocks rather than bonds. Essentially, that is the idea of the play. Now, when it comes down to trading, and this is the key thing, this is what you really need to be thinking about, is how are you going to trade these economic releases? So you've got the number, and what you need to be establishing for yourself is what would be an outlier, what would be out of range that would get you to actually take on a trade. So that's the first thing. When you're summing up what would be an outlier, so say the range is on non-farm payrolls, it's expected at 200, and the range is 150 to 250. Anything outside the range is likely to create a bit of a move because no one is expecting it. Also, think about what the number has been doing in terms of, are we at record levels? Is there a trend beginning? So, for example, if you'd started seeing GDP fall and we're getting closer to zero, are we then possibly stepping into a recession? So look at the actual figure, how these numbers have come out in the past. That is very important. Get those things in your mind. And then the next thing, of course, is market structure. So remember that. How's the market structured? If you've got, say, a market that has produced a bit of a double top and we're coming off and we're trading around here, if you get a number that is good for the market, are you going to get a break? Is that going to initiate a move higher? And also, what number has it got to be? So keep that in mind, how the market is structured. You know, if the market is perhaps in a very strong up move, it is more that perhaps you want to be thinking about what's going to get that move to continue. So you're always looking at, is there a number that will get a continuation? And is there a number that will get a reversal? If you don't see that one of those is there, so perhaps you don't see a reversal if this market is trending higher, then it's a question of how big, how far out of line has it got to be to get that continuation going, to get you to actually trade it. So next up, you want to be looking at your actual plan. So your plan for every figure, how you are going to trade it. So what are you going to do? You're going to be looking straight at the number, and you first got to judge, is it out of line enough? And have your range, and also know what to do if it's not out of line. Is there a trade on that as well? So say you're expected at 200 and the number comes in at 210. how much of a move is this going to create? Say this is non-farm payrolls and it is in equities. Are you going to see a move up and then actually it's not that big and a move back down, as opposed to if this was 310, your expectation would be to see a trade a bit like this, pull back and continue. Are you then going to see instead on the 210 a move a little bit more of a move higher, come back, failed high, and then as you break here, you're looking for an entry actually to fade the number back. So that's what you got to have in mind. What are you going to do if it comes out 210? What are you going to do if it comes out 310? So be very aware of that in terms of what you expect the market to do, whether you're going to see continuation type trade, pull back and go, or are you going to see a fade? Now the next thing is execution. Think about how exactly you're going to hit it. Are you going to just hit market? And if you are, how many prices are you willing to hit market either side of where the market's trading? So how far? Again, going back to our example of 310, the market moves, say, 10 prices before you can get in. Are you still willing to buy it there? Do you think the move is going to continue enough, or are you going to wait for a pullback? Are you going to wait for the number to come out, analyze it, and then trade? So wait for that pullback. And from studying the numbers, you're going to know whether it's likely to pull back. So look at the nuances of numbers. Note down. Take notes on every number. Remember that, very key. Take your notes. What this will do is allow you to then look back, and you might be able to find nuances that actually it doesn't matter what the number is, it always follows a certain pattern. So that's going to tell you, do you have a pattern play on it? So think about that. Think about your pattern play. Is there something there that you can consistently just execute? Or is there a fade on it? And if there is a fade, how far has it got to go? Again, it's all about how far. If you consistently from your notes notice that the S&P moves 10 handles on non-farm payrolls and the number is not that far out, if you get to 10, then you've got the potential of a fade if you get that type of move. So be very aware of, know your market and know the number as well. What is too far? Or not necessarily too far. You can't ever say that the market has gone too far, but what is far enough that it is likely to then produce a possible fade trade. So be very aware of those things. Make those notes. Remember every aspect of how figures change, and also what your notes are going to do is it's going to show you popularity of certain figures. So as a certain figure takes more center stage, you're then going to be able to start trading that a little bit more actively. For example, housing is now much of a muchness for a figure. However, 2008, when you had the financial crisis, housing numbers were exceptionally important. So finally, do the same thing when it comes down to company and government news. So in terms of your company news, things that you're going to be looking at, your earnings. Now remember, you're looking for EPS, you're looking for revenues, and you're looking for any kind of full year guidance. They're the three areas that you're going to be looking for. Trade these, treat these like a figure. Remember that a company's size within the index is going to be very important. There's no point in worrying yourself trying to trade very small companies that have very limited market weight on an index. So size of your company is very, very important. And again, what is in focus as well on those earnings. So, for example, if tech companies are very in focused, they're going to be the ones that produce the bigger moves. So it's all down to sector focus. If you get a lot of focus on a certain sector, then that's where you want to be trading. You want to be looking at those firms. Again, going back to 2008, banks, and autos were very key because they held a lot of loans. The auto companies did too. Whereas now you're seeing a lot more tech companies, and so they have the focus in sort of 2017. And that's been the case for a couple of years. So make sure you know what sectors are the most important. Again, the earnings do not come out at a set time. So take your notes. Your notes are going to give you a clue, and that will give you a little bit of extra speed when you're trading these type of things. And trade it exactly the same. Get your plan. Know exactly how you're going to execute, where you expect to get out, or how far you expect the market to go, and what is going to give you a stop, what is going to tell you it is time to get out of that trade. So they're the things you want to be thinking about when you're looking at company news. Other company news, M&A. Remember that the company being bought, their shares will rise. So keep that in mind. Again, size is always the key to this. I showed you the example of Monsanto and Bayer. Bayer, very, very big component in the DAX. So that's going to massively influence the DAX, whereas Monsanto, not such a big component of the S&P. So less impact there. Again, the acquiring company, their shares will generally fall. Watch out as well for any kind of rumours and denials. These are always areas where you can have a potential trade. Now, M&A news is always going to be ad hoc, remember that. So if it's ad hoc news, it means that you are not necessarily going to be able to trade it just, you're not going to know when it's going to come out, so you've got to be very quick to know your market, know the components of your market, and know the implications for that. So because it's ad hoc, know your market. And also watch out for that removal from an exchange. I've showed you a great example of it in the FTSE, of how it can affect the closes. So do watch out for that removal from the close. Now, last up, we were talking about government auctions. Quick reminder, the main play that you're going to see on a government auction is selling into it, because the people who are part of the auction are going to be getting these bonds. Therefore, they hedge them, or they pre-hedge them by selling the bond market that is relevant. So say Italian BTPs will get sold prior to the auction. Then, if they've sold more than they should have, you will then see the hedging flow the other way as positions are unwound. That's the key thing you want to be watching out for on auctions. That's what's going to give you the opportunity. It is going to be very much based on how the price trades. You're not necessarily going to know how much hedging people have got to do or how much they've actually got of an auction. Now, size, again, is key. If it's a very small auction or a tap is where they are auctioning a reissuance of a bond that is already out. These have less influence. Big size, new auctions are the ones to be watching out for. Now, key things you want to be watching out for is bid to cover and your tail. They're the two main things. Now, if you remember, what you'd have is banks will submit their bids at different yields for whatever the auction size is. Once the central bank has got, or the government has got, the amount of bids that they need, they will then have a cut-off price. Anyone bidding above this cut-off price does not get filled, but what it does show is your bid to cover. So if you've, say, got 20 billion for a 10 billion auction, then you have a bid to cover of 2-to-1. This is showing good demand. But this is where the tail comes in. Anyone who doesn't get filled constitutes part of the tail. So that is the distance from the settlement price and out to the furthest bid. So if you're then seeing that people are actually asking much, much higher yields, then it shows a little bit of lack of confidence. So they're the two key things you want to be watching out for. So that's going to show the strength of the auction. And likewise, if you see a very low bid to cover, you could end up with an unfilled auction, and that provides a great deal of weakness, and you then start seeing a further move lower, as that shows very little demand for the bonds of a certain government. So that's the key thing with any of this macro news. Always remember your plan, exactly how you're going to execute. This can be separate from individual trades, but have a plan, know exactly what you're going to do and execute it very precisely. These opportunities will come up very regularly, so you do have a lot of chance to practice. Go back over exactly what you did, where you got in, where you got out, and see if you can improve that in any way. So that's the key thing with the macro news. Just be ready, be very well prepared for it, and know exactly how it's going to influence the market that you're trading.